This is a big deal. If the Fed stops buying, which they will in the near future, guess what happens? You just lost your major buyer of mortgage-backed securities. And when you don't have a buyer, when you don't have that demand, when you don't have demand on something, guess what happens to the price? Price goes down. And if the price goes down on a mortgage bond, the yield goes up. Interest rates will go up. So that's what we have to look forward to once the Fed starts tapering their purchase of mortgage-backed securities. Hey, Rick Elmendorf here, loanwithrick.com, powered by Movement Mortgage. And in this video, we're going to go over the Federal Open Market Committee's statement. Yep, that's right, the Fed. They had a nice little statement today, a meeting, and want to discuss what impact this is going to have on interest rates, housing, and the immediate impact for those that are purchasing or refinancing a home. All right, let's get right to it. So first and foremost, I'm going to read you some of the statements. I'm going to summarize them, and then I will get into the nuts and bolts of the matter here and how it affects all those three things I mentioned. So first and foremost, the Fed left rates unchanged. Now, what the Fed changes is the federal funds discount rate. I'll read what they said. They said the committee decided to keep the target rate for the federal funds rate at 0 to 1/4% and expects it will be appropriate to maintain this target range until labor market conditions have reached levels consistent with the committee's assessment of maximum employment, and inflation has risen to 2% and is on track to moderately exceed 2% for some time. Now that's a mouthful, but basically what they're saying is that we're not going to really do anything until we see some of the things we're projecting actually happen. So that's really the bank's overnight lending rate. It's going to affect more of the consumers, but it does put pressure on everything else, including mortgage rates, housing, and whatnot. So the second thing they said, which was that the Fed raised their inflation forecast from 2.4% to 3.4%. Now, remember, their target rate's 2% per year, right? Now, they already had the inflation forecast at 2.4%, and they raised that to 3.4%. Now, why is this significant? It's significant because inflation is the arch enemy of mortgage bonds, okay, of bonds and mortgage interest rates. When we have inflation, that puts pressure on interest rates. Interest rates are higher in an inflationary environment. And where are we right now? We're in a non-inflationary environment right now. Interest rates are super low. Obviously, we had a lot of other factors happening, but that's pretty much the soup and nuts to it. High inflation, high mortgage interest rates. So them actually saying that not only are they saying more than what they had expected, they're going even higher on their forecast up to 3.4%. That is very substantial, and the markets did not think nicely of that. In fact, they are down almost 50 basis points from when pricing came out today, and we are starting on what I feel is a landslide on mortgage-backed security pricing, which is going to lead to increased interest rates. The other thing they said was that employment is expected to come down to 4.5%. Now, currently, the national unemployment rate is 6.1%. Now, think of it this way. The more people that have jobs, the more people buy stuff, which is inflationary, right? So unemployment is a massive factor in where mortgage rates are heading and what's going to happen with housing. Now, the last thing they said, well, they've said a lot more than just these four things, but this is one of the main things I gathered here. The Fed is going to maintain asset purchases of $120 billion per month. Now, if you didn't know this, the Federal Reserve is a massive buyer of U.S. Treasury securities and mortgage-backed securities, which directly impact mortgage interest rates. Now, what they said was, and I quote, he says that the agency, they will continue to increase its holdings of both Treasury securities at $80 billion a month and agency mortgage-backed securities at least $40 billion a month until substantial further progress has been made towards the committee's maximum employment. There's that employment again, and price stability goals. There's inflation. Okay, so this is a big deal. If the Fed stops buying, which they will in the near future, guess what happens? You just lost your major buyer of mortgage-backed securities. And when you don't have a buyer, when you don't have that demand, when you don't have demand on something, guess what happens to the price? Price goes down. And if the price goes down on a mortgage bond, the yield goes up. Interest rates will go up. So that's what we have to look forward to once the Fed starts tapering their purchase of mortgage-backed securities. Now, what impact is this going to have on rates, housing, and moreover the immediate impact for those that are purchasing or refinancing? Let's get into that. So let's look at rates first. Now, nobody will argue with me when I say rates are artificially low. they have to go up. I use the analogy of a yo-yo. You throw the yo-yo down all the way and it's going to bounce back up and it's going to go back into your hand. Anything that goes down too fast or up too fast will correct. So that's one of the main things that are going to be happening with interest rates. They're just too low right now. It's not sustainable. So they have to go back up. I gave you a more technical answer to these things, but that's really it. Secondly, let's look at housing. Now, I'm going to give you 4 reasons why I think we're primed for a housing crash. Yes, I did say a housing crash. Nobody flame me, please, in the comments, but I will tell you this. I'll give you the 4 reasons I think we're going to be there. Number 1, we've had too much appreciation too fast. Just like we've seen interest rates go down too low, too fast, and stay there, we've seen housing appreciate way too fast. So I looked up the median national median home prices since like 1954, and it showed that the median home prices just for last year were up over 10%. The figure was like $270,903.40 to $300,986.69. That was in 2020. Now, in most major cities, we saw a lot more of appreciation. We saw in some markets, in my market, Northern Virginia, down here in Florida as well, you saw like over 25% appreciation in 2020, which spilled over into 2021. Too much appreciation, way too fast. It has to come back. Second reason, rates will, and are, by the way, going up. So the estimate is that I think some MBA statistics said that we're going to be at like 4.2% by the end of the year. Could be up to 5% by next year. I don't believe in the 5% next year. I don't think we're going to get there. But let's just call it 4%, 4.25%. By the way, that's normal. That's a normal interest rate. 2.75, not normal. Not normal at all. Now, so if the estimate is that we're going to be at 4% by the end of the year and higher into next, this is going to increase the cost for the same house, right? So that less borrowers qualify, home prices go up. This is a second reason I think we're going to see a housing crash. Now, third, buyers are already tired. They're already tired. They're dealing with multiple offer situations. Most buyers have to make an offer on 4 to 6 homes even just to get even a look at the house or get their offer accepted. And they're paying way over the list price on average. So buyers are tired. And this is, by the way, evidenced by following home sales data. You know, here's the big issue. Buyers are now starting to realize that maybe we just don't buy. Maybe I'm willing to sit out because I think the market's overheated. Buyers are starting to figure out that they can just sit out, wait till the market cools, and then buy. They're looking at other options. That's the third reason I think housing is going to crash. And then the last reason all has to do with the supply of homes. Now, in this market right now, you're seeing a lot of buy before you sell sellers, meaning that I have a home to sell, but you know, if I sell, I know I'm going to sell in a heartbeat, but where do I go? That's the question. So what they're doing is, let me go ahead and try to fight to find something. Then once I get under contract, I'll try to make the contract contingent if I have to, but knowing it's going to sell in a day, I'm just going to buy first and then I'm going to sell. So you have this unearthed inventory that's sitting there of all these home buyers. Home buyers are outnumbering home sellers at least 30-1 right now in my market. Could be even higher than that. But you have this less buy then sellers. And in my opinion, all the buy first, sell later sellers are going to start freaking out. Then they're going to start listing first. Now, you're going to see this is already happening, by the way, with this year. We're seeing an increase in the home for sales. If you look at since the beginning of the year, we've seen an increase in the inventory, nationally speaking, and especially in the Washington metropolitan DC area. In a lot of these major markets, you're seeing more homes on the market, less home sale data. Now, how are home prices still high? How are we still having these escalating offers? Nobody's woken up to it yet. The demand is still there because that's just what everybody's expected. Warren Buffett said it was said that appreciation is there, it's happening. People are charging more for lumber, this and that, and it's being accepted. Well, sooner there's going to come a day where people are not going to accept it. I will tell you this is the first step towards a buyer's market and price reductions. All these buy, then sell sellers are going to start listing first, and in compilation with all these other things, too much appreciation, the rates are going up, buyers willing to sit on the sidelines a little bit, you're going to see a massive change. It's very eerie to what happened in 2008 when all of a sudden when the bottom started falling out and all the problems with the subprime mortgages and everybody like, oh my goodness, what's going on? Liquidity kind of went away there. And then all of a sudden, housing crashed. Anyway, I hope that doesn't happen to us. And it's not the same thing that's going on in today's market, but those are 4 reasons I have by way I think we're going to see a market crash. Now, do I think we're going to see a market crash like as in like 50% like we saw in some markets back in 2008 or 9, whatever it was? No, but I think we're going to have a correction back to normal, which means, okay, maybe we're going to lose a 10%, 10, who knows? Well, we'll see. There is going to be a correction. Now, what is the immediate impact for those that are purchasing a home or refinancing? Now, first of all, let's deal with the easy one, refinancing. There's just going to be a loss of savings. When rates go to 3 3/4, 4%, it's just not going to be an option anymore for people. Right now, you've got people that are still able to refinance for low 3%, 3.25%. They're currently at 3.75. Maybe they can do it at no cost. You have a VA loan, you can get still, at 3% or less. You can keep your costs down. It's just not going to be an option in the future. So it's just an immediate loss of savings. Now, purchasing. This is the more difficult issue here. Purchasing, the immediate impact of these rates and all these statements that the Fed's making, when the rates go up and when all these things happen, it is really just a domino effect. Purchasing the same home is going to cost substantially more. So if you just take a $500,000, I just did this estimate on a VA loan, $500,000 VA loan, today's rate at 2.75%. Now, if you take that same interest rate, that same $500,000 and move it to 3.25%, that mortgage payment just jumped up $134.82. Take the rate to 3.75 and the payment for that same $500K mortgage jumped up $274.37. Now, the secondary issue is that a 1% increase in your payment typically increases a borrower's debt to income ratios by about 3%. That's substantial. When you talk about most of the borrowers out there are kind of just riding the red line, right? And they're at that 42, 43, you jack it up 3%, maybe you don't qualify anymore. So that's going to be a big issue here. The other resort you're going to find is that, like, as I was mentioning before, you're just going to have more buyers just willing to wait and see. There's going to be more rentals, more military families settling for base housing or around renting. It's just, that's what's going to happen. All in all, the markets are shaken with these comments. Housing, I believe, is right around the corner to see a massive correction. I hope I'm wrong, but I just see the writing on the wall. For those of you who know that know that reference, there you go. The writing is on the wall. Well, I hope you like this content. If you do like it, please go ahead and give me a thumbs up, subscribe to the channel, and please do, if you feel so inclined, to pop me a like. It does help me out a lot. And I will see you on the next video. Thanks. Have a great day.